If Apple's shares reach $175 at expiration, the call option holder finds themselves at a critical juncture with several potential outcomes. A call option grants the right, but not the obligation, to buy the underlying stock at the predetermined strike price. In this case, if the strike price of the call option matches the current market price of Apple shares, $175, the option is considered at the money. At expiration, the option holder has the choice to exercise the option or let it expire worthless. If they choose to exercise, they can purchase Apple shares at the strike price of $175 per share. However, given that the market price is also $175, there would be no immediate profit or loss from exercising the option. Alternatively, if the option holder decides not to exercise the option, it expires worthless, resulting in a loss equivalent to the premium paid for the option. This premium is the upfront cost incurred to purchase the call option, representing the maximum potential loss for the option holder. Additionally, traders must consider transaction costs, such as brokerage fees, when evaluating the profitability of exercising the option. These costs can eat into potential gains or exacerbate losses, influencing the decision-making process at expiration. Ultimately, the decision to exercise the call option at expiration hinges on various factors, including the trader's outlook on Apple's future performance, market conditions, and the cost-benefit analysis of exercising versus letting the option expire. Traders must carefully weigh these factors and assess the potential risks and rewards before taking action. While exercising the option allows the opportunity to acquire Apple shares at a set price, it may not always be the most profitable choice, particularly when factoring in transaction costs and market fluctuations.